Oh, great to have you with us. And a couple of big stories that we are tracking this morning. Obviously, on the geopolitical front, the next move from U.S. President Donald Trump in the Middle East is being tracked by stock traders, oil traders, the entire market. But we also got an update from the U.S. Federal Reserve yesterday. In no rush to cut interest rates, even though there are some increasing signs of weakness for the U.S. economy, a lot of that has to do with some of the policy that we talk about here in Canada every day, some of the trade tensions and the inflationary effects that are coming from that. So it is something that investors are going to have to chew on as we move into the summer months. Lesley Marks is Chief Investment Officer at Mackenzie Investments and joins us here in studio. Lesley, great to see you.
Great to see you back in the chair, John.
Yeah, likewise. And I guess we should start with some of these macro factors that central banks are having to navigate right now. I'm not sure what the market really wants from the Fed at this point. I mean, if inflation is going to be a concern, they don't want to cut interest rates, but we are also starting to see some cracks in the economy there too. So what's your take on what's going on?
Certainly, and I think the Federal Reserve, first of all, I think the decision yesterday was not a surprise. So that's order of business
sort of
number one,
leave
not to cut rates, despite the comments that we've heard from the Trump administration and the president himself trying to pressure the Federal Reserve to cut interest rates. Excuse me. The Federal Reserve, though, is very much forward-looking. And as the Bank of Canada noted last week, there is still a lot of uncertainty around what the impact of tariffs will be. The suggestion is that in the current inflation data, that we're not really seeing the impact of tariffs just yet, and that we may not see that until the fall. So the Fed wants to be ready to cut rates, except that in the case that they start to see inflation, that's going to make that rate cutting decision more difficult. Now, that's a little bit different than the Bank of Canada, where they also want to be ready to cut interest rates, but they believe that they had a little bit of time on their side to continue to pause here, and they can look to cut interest rates if they see the Canadian economy really fall off later this year.
What do you think is the biggest determining factor on that front? There was a speech where Tiff Macklem talked about some of the inflation issues. They like to look at so-called core inflation, but it sounds like they're watching the job market pretty closely.
Well, yes, the job market is very important. And again, that's another area where we have a big contrast between Canada and the United States. We've only seen an inching up of the unemployment rate in the United States, as opposed to Canada, where we've seen a pretty significant rise in unemployment. In the United States, we have a very high participation rate of labor. We also have another issue around immigration, and that is going to also decrease the size of the labor force. So the U.S. unemployment rate could continue to stay low. It may move up marginally, but in Canada, we have a different story. In Canada, the unemployment rate continues to move up, and we're really watching that. And that's what Tiff Macklem is really focused on. So his key data right now is the unemployment rate. The Federal Reserve's key data is CPI.
Okay, let's talk about, Wall Street and Bay Street are watching Main Street, but the broader story on Wall Street and Bay Street has been resilient stock markets. The S&P has come a long way from the weakness we saw earlier this year. The TSX has been hovering around all-time highs. Every time I talk to smart people like you, they say, at least with the TSX, a lot of that story has less to do with what's happening with the Canadian economy and just more with some of the global appetite for some of the stuff that makes up the TSX.
That's right. Now, if you look at the TSX, it's generally more levered to the global economy than the Canadian economy. What's really been moving the TSX or supporting the TSX has been the material sector, and namely gold. So it's a bit misleading to see the strength in the TSX and say that that's somehow connected to anything other than what we've primarily seen, which is the strength in the gold price, and that leading into a favorable outcome for gold companies. So that's really the primary driver of the TSX. But you make an interesting point, which is that, if you sort of started the year in January and went to sleep for 6 months and then looked at how markets are today, you would have missed all of that big downturn in April and then the recovery. So point to point, you would never have guessed that we would be where we are given the backdrop of an escalation in tensions and war in the Middle East and the level of tariff uncertainty that we are seeing today. So I think generally it's been surprising to see how markets are today versus what we know is happening in the background.
I guess as a final point, this block, if the Fed doesn't feel they're in a position to cut interest rates right now because they've got these inflationary concerns, but if we continue to see signs of weakness for the U.S. economy and a stock market there, which is basically around all-time highs, I would say the more bearish view out there is, yes, people have been looking for equity opportunities beyond the U.S. this year. That has benefited the TSX. It's benefited European markets. But if things start to go really south with the American economy, especially with some stocks at elevated levels, that's not necessarily a great sign for equity investors. And generally speaking, the U.S. will pull down the rest of the world, even if people are choosing to put more money outside of the U.S. right now. So how would you be thinking about positioning for sort of a best case and worst case scenario into the end of this year, let's say?
Well, I think that in the U.S. economy, or for the Federal Reserve, the worst case scenario is declining growth and increasing inflation. I mean, that makes their job really difficult. I think in that scenario, if they believed that the inflation numbers were transitory, in other words, we were seeing a movement higher in prices because of tariffs, but that they didn't think that that was sustained, they would probably look to cut rates to support the economy. Now, of course, that would be in the context of seeing unemployment also rise. So there's a lot of moving parts there. But the other factor that could be impacting the outlook for the U.S. economy is the oil price. The oil price has moved up 30% since the beginning of May. That has a tightening impact on the U.S. economy. So the Federal Reserve will be watching that as well. So as far as positioning portfolios, very difficult right now. When we look at positioning our portfolios, we're obviously looking at the balance between what we expect to see the reward and the risk. And right now we see between, at the highest level, stocks and bonds, the risk and reward equation is fairly balanced between the two asset classes. We see things that could move each of those asset classes in price higher, but we also see things that could move them lower. So I know that's not very definitive, but we see that as the state that we're in for the next little while. But the next phase after that, we see as a much more optimistic phase, pro-growth, both here in Canada and the United States, related to the fiscal support that we think is going to stimulate both of our economies.